Good afternoon, everyone. Welcome to this webinar on tax planning and superannuation strategies. My name's Peter Lacandro, the Managing Partner of Financially Sorted. Sorry, I'm a little bit late. We had technical gremlins out there at the moment, but we're all up and running now. So thank you for joining us. We as a team at Financially Sorted, we thought it'd be a great idea to talk and communicate with all our clients about what should be happening right now. Before and certainly well before June 30 and the end of the financial year. Obviously, as a team of tax professionals, we're all here to assist. We'll continue to email you and communicate with you via email, via newsletters, conversations that we have, social media, and everything else that we normally do. So please reach out if you need our assistance, whether it's with end of financial year coming up or anything else in that regard. The great news is the team generally are back working in the respective offices, obviously at Moonee Ponds and Wheelers Hill. And we'd certainly, on behalf of the team, I'd just like to say a quick thank you for the crazy times that we all have gone through, and sometimes we still find ourselves in, obviously with still some COVID and flu issues going through the population at the moment as well. But we'll continue to do our best and run webinars like this to assist you all. All right, before we get stuck into it, I must give this general advice warning. This webinar is not designed for your particular circumstances or taking into account your particular situation. Like I said, we're certainly here to help, but please seek the appropriate advice where you need to in relation to your circumstances. There's many rules, there's many strategies that many of our clients and businesses out there utilised to legally minimise taxes each year. Certainly in 60 minutes, we can't cover everything. And like I said, bear in mind everyone's situation is totally different. So please ask if you need further assistance. All right, so it's fantastic today to have many of you along, clients and new followers as well, and hopefully I'll go a long way towards answering some of your questions. What is going to be on the agenda today, or what will we discuss? So what is tax planning we'll look at? Why is it so important? Many people say, why should I do that each and every year? How can I minimise tax deductions, or maximise, I should say? And we'll also look at some superannuation strategies that you should be considering with the possibility of adopting. And then towards the end, we'll also look at what's next, what can you be doing. Just to let you know, feel free to use the comments tab at any point, and providing we have some time at the end of this presentation, I'll certainly go along and answer the questions as best we can. A recording of this webinar, along with the PDF slides that we'll go through, will be posted on our website for you to access. Give us about 24, 48 hours to do that, and you'll certainly be able to, like I said, access it if you wanted just to double check on a certain area. All right, let's get stuck into it. So why is tax planning so important? And the main objective of tax planning, the feedback that we get is to reduce the amount of tax that you either have to pay personally or through your business. And it obviously leaves you with more to invest in the future. By understanding your tax liabilities, whether they're right now or coming up in 2 months or 6 months' time, it allows you to reinvest into your business, or allows you to basically work out where your true cash flow position will actually be. So a couple of questions to ponder if I probably start asking you this, or you should be asking yourself. As business owners, Who of you out there actually know or truly know and understand what your business numbers look like for the coming financial year? You know, we should be discussing margins, improvement strategies, and a simple little 1 or 2% improvement each month can make a massive difference to the bottom line overall. So remember, business operation, it's not a 100-metre sprint at the Olympics, it's more like the marathon. And for the individuals out there, who of you truly know what your mortgage balances are or your superannuation performance is? And mortgages are obviously very topical at the moment, which we'll look at a little bit later on, with the 0.5% increase that was passed on Tuesday with the Reserve Bank. And the worst part is that it's predicted to happen again in the coming months. So that's quite scary, and it's certainly something that you should be on top of. And with your superannuation, don't wait till you're 59 to look at it, because have I got enough to retire? What could you be doing today? Where is it invested today? How is it performing today? And these are all different little things that we can use to basically ensure that our wealth position is improved. And that's why tax planning each year, and it should be happening on a more frequent basis, becomes very important. Tax planning is a process of analysing and evaluating, like I said, either you as a business or as an individual, your current financial profile or your financial position. The objective of this activity, it's simply to minimise taxes and keep your hard earned in your pocket. And in short, tax planning is employing ways that the government has provided to us, utilising the various rules and legislation to save tax. Okay, tax planning though, it should be done regularly. Don't wait until the 30th of May or the 9th of June being today. Do it on a monthly, do it on a quarterly basis. It makes the process and the effectiveness a lot easier as well. Tools of tax planning. What are some of the common tools that we utilise and what are available to us? The common one which most people talk to us about is, Peter, what tax deductions are we able to claim? Or what has the government introduced that wasn't around last year? We can also utilise various government rebates and offsets. And certainly through the last couple of years with COVID, that's been very topical. We can also control somewhat when income is recognised in your financial reports. So maybe if you've had a bumper of a year, can we offset some of that income to the next following year? Or maybe if you're going into retirement next year and your income is dropping, wouldn't it be perhaps easier to offset some of the income to a lower tax area? And what can we take advantage of if we reinvest back into the business? And that's also important with property owners out there. What can they invest back into the property or buy the next one to assist with? So before we look at some of the tax planning opportunities and options out there, I just wanted to touch on one little thing. ATO. Reviews and audits. Please be very, very careful. The ATO and the government, they've spent a hell of a lot of money over the last 2 years, and they will and they are starting to investigate and to prosecute those that have outstanding debts. So not just with those that perhaps have claimed something like JobKeeper illegally, but with tax return lodgements, and this will flow on to businesses as well. So I do bring to your attention that the ATO are trained to do their job, to investigate, just as we're all trained to do our jobs. And we are certainly seeing the increased use of technology by the ATO and other government departments around data matching programs or averaging programs to look at certain areas that perhaps they believe that they can have a go at. So be very, very careful in that regard. And basically what's happened in the last budget, so back in March 2022, at the time we had the Liberal government in power, and they've allocated a lot more money, and as you can see there over the coming years, to the ATO to basically allow the government agencies, so that'd be state revenue officers, that'd be the ATO and other government departments, to review, to investigate, and to simply ask questions. So be sure that your records are up to date, be sure that they're accurate, and be sure that if you've got a concern or a problem, that you're talking to us is the key. And another part of that I just wanted to share out there is be very careful. We did simple touch payroll, phase 2 is coming. So basically a more detailed email was forwarded to our entire database back on the 1st of June, or just last week, which highlighted the extra reporting requirements on behalf of all employees and the ongoing requirements moving forward. If you need a copy of that, please just let us know. But more importantly, it's all been placed on our website under the news section for your reading and for your access. And the action points are noted in that news section. So feel free to have another read of that as well. All right, so let's have a good look at it all. Tax compliance and integrity, or what should we be basically doing? There's two main objectives with tax planning. The first one is on the income side of things. So how do we legally minimize our income to reduce our profit? And on the opposite side of that is expenses. So can we bring them forward, or can we be taking advantage of certain government offsets and rebates, which will help us in a better position come tax time to pay less to the ATO? Let's have a look at the first one around both tax planning and strategies. And what we're going to look at the moment is on the income side of things. So let's have a look at a couple of strategies to legally minimize income side of things moving forward. So we can utilize salary sacrificing, we can utilize mortgage offset facilities, and we can legally delay income in certain circumstances. So let's have a bit more of an in-depth look on some of those. So salary sacrificing. What is salary sacrificing? It's something especially a lot of individuals out there utilize to minimize legally their tax bill. It involves using your pre-salary to buy goods and services that you normally buy with your after-tax pay. And because of the eyes of the tax department, you're earning less when you're salary sacrificing. And what does that mean? It means you are taxed less. On the employer side of things, be very, very careful, because sometimes FBT implications could arise. So depending upon what your team members are asking you to sacrifice for. So FBT is another topic again, and we certainly cannot cover that in 60 minutes, but be very careful. Speak to us if you need any further clarification. Let's have a look at a working example of how salary sacrifice works. So we have Terry Danaher. I thought you can recognise who I barrack for. Maybe not at the moment though, not very good. He's on a salary of $120,000. And he basically would like to salary sacrifice $13,000 and send it to his own self-managed superannuation fund. And let's just assume that there's no other major issues in this case. Let's have a look at some numbers. Basically, normally what would happen, or pre-salary sacrificing, with here in column 1, he's on a salary of $120,000, taxes that he would pay, including Medicare levy, just over $34,000. So that's what would normally happen, and he would basically lodge a tax return accordingly. Now, remember what we said is Terry wanted to salary sacrifice an extra $13,000 to his superannuation fund. So what would happen now, his earnings would drop by that amount. to $107,000. That would give him a tax bill of just over $29,000, reduced down from $34,000. So basically, though, when his super fund receives that $13,000, it would get taxed at $1,950 at 15%. So obviously here, there's about a $5,000 saving in taxes. His super fund would get taxed at about just under $2,000. So we have an overall tax saving of $3,120 because Terry decided to send this money to his superannuation fund rather than keep it as wages. So the extra benefit as well, and that clearly shows the power of salary sacrificing. There's an extra benefit also. The extra benefit is that he has just on $13,000 after taxes remaining in his superannuation fund, number one, to invest and hopefully earn a bit more. And number two, that'll be available later on in his life for retirement purposes. So that's a very, very simple example of salary sacrificing, but if done correctly, it can be quite powerful as well. Mortgage offsets. So what is a mortgage offset? And this is certainly something that is very topical because of what the Reserve Bank did a couple of days ago by increasing interest rates. They also rose the month before. And like I said, if you speak to the so-called experts, they're predicting that it will continue to rise in the coming months towards Christmas. And this is partly to do with the cost of living as well, as we all hear about every day and unfortunately are experiencing. So mortgage offset account, it's basically a transaction account that is linked to your home loan. The account balance is offset daily against your home loan balance. So basically, you only get charged the interest on the difference between the total loan balance and the amount in the offset. So let's have a look at a working example as well. So we have Lauren Jackson. She currently has a home loan at about $1 million and is paying roughly 4% interest. She also, though, has $700,000 just sitting in an everyday bank account that earns approximately $2,000. Okay, and that basically is, let's just assume there's no other major issues. So how does an offset facility really work? So again, column one, she has a home loan of $1 million at 4%. She obviously has an interest bill of $40,000, and because it's on her private home, that would be non-tax deductible. She has a cash account earning 2% interest, so that $14,000 would get included as assessable income in her tax return and get taxed at her marginal tax rate. Okay, then what happens if she sets up or offsets the two? So what would happen in this case is we basically are left with a balance of $300,000 that she in her home loan. So that's the $1 million minus 700, and basically the interest at 4% would be $12,000. Again, non-tax deductible because it relates to her private residence. That represents $28,000 saving in interest alone. And we haven't spoken about the fact that this $14,000 wouldn't get included in her personal tax return as income, so it'll also save some tax dollars on top of that. So if you've got something like this, it's certainly worth the exercise to speak to the banks or to speak to the brokers. So sometimes we get asked questions, well, how do we set this up? How do we get something like this? And basically, firstly, on our website, under the resources section, there's a brochure. So if you wanted to understand a little bit more about how a mortgage offset account works, please access that and have a read of it, and feel free to ask any questions. Also in relation, well, how can we get this set up and how can we take advantage of such a strategy? Stay tuned and I'll give you some details later who you can contact to help with all that type of stuff. And the third and final one that we were going to have a look at under the income side of things is how can we legally delay income? So be very, very careful with such strategies because you need to tick the right boxes. But basically, can we defer invoicing? So can your cash flow standard, and can we basically think about deferring invoicing till after June? A 1 month delay in billing will mean that you'll pay tax on income a whole year later, a whole financial year. Mind you, though, the opposite to that is your clients or your customers might want to be billed pre-June so that they can claim a tax deduction. So this is basically where a few days in billing will usually also mean that you possibly could get paid a whole month later. So be very, very careful with such a strategy because it needs to be done correctly and your business or your cash flow must be okay to stand such a strategy as well. All right, so we've had a look at minimising some income side of things. How about tax planning or around what other tools can we use? So firstly, can we accelerate some tax deductions out there? Is that an option? Can we utilise government offsets or rebates that have been provided, especially over the last couple of years? Controlling when income, which we just spoke about, is recognised. And can we invest or reinvest back into the business? So let's, the couple that we're going to have a look at, or a few that we'll look at how do we bring forward expenses, prepayment of expenses. There is still the 150 full expensing of eligible assets for businesses. So we'll have a quick chat about that. And then we'll also spend a little bit of time on superannuation strategies and contribution levels for this current year as well. Okay, so the first one is bring forward expenses by a few months. So quite simply with this strategy, if you're going to be spending money in July, August, or perhaps even September, is it worth actually doing it now before June 30? So perhaps if you know an insurance premium bill is going to arrive in July, maybe contact them and ask them to send it to you in June. Can you be purchasing printing or stationery or computer supplies in June rather than July or August? Is there any office equipment that you may need? Is there any repairs to your office or your factory or your work premises that maybe make sense to undertake in June rather than July or August? Can you prepay some small telephone or electricity bills? Perhaps July's rent can be paid in June. Super contributions, make sure they're paid before June 30 rather than on July 21st, for example. Get them done before June 30. And the list can go on and on. So basically what we're looking here is don't just spend money for the sake of it, obviously, but if there's things that you know that are going to be happening in the coming couple of months, perhaps bring them forward into this financial year. Extra tax deductions equals less bottom line, which will basically minimise legally some taxes as well. So that's where expenses are coming in the next couple of months. What about things up until 12 months, so prepayment of expenses? So there's what we call a 12-month rule, which allows for a deduction of a prepaid expense in the current year and does not, as long as that expense that we're prepaying does not extend for greater than 12 months and is by the end of the following financial year. So some of these things may include, or prepaid expenses, which we know a lot of clients utilise. Can we prepay rent in advance or leases that you're obligated to pay? Insurance policies up to 12 months, perhaps some business advertising or marketing expenses, and even upcoming subscriptions that you may have, whether it be computers or business subscriptions. All small businesses should be taking advantage of these type of things. And basically, what are the rules? As long as you're carrying on business and you have aggregated turnover of less than $10 million, you are regarded as a small business that can utilise these rules. So again, what can you prepay? A lot of people also, especially property owners out there, sometimes contact their banks to prepay the interest for up to 12 months. Why? Because that gives them a far bigger tax deduction in this current financial year. Please be careful, and again, speak to us if you need further clarification. Okay, so we've all heard about this one, or we should have, because we know we've been talking to clients for a couple of years, and certainly when we've been completing your financial statements and tax returns, we've been taking advantage of this. So full and expensing of an eligible asset under the COVID relief rule. So on the 6th of October, back in 2020, basically if you purchased an asset after that date, and up until, well, this has now been extended to the 30th of June 2023, it may be fully deductible. And this is basically available to all basically assets, like I said, under $150,000 per one. So the government decided when COVID attacked us all a couple of years ago that they wanted to encourage businesses to spend money on equipment to keep the economy ticking over and to build for the future. And basically that's why they introduced this rule, to allow you and I as small and business owners to basically purchase equipment and purchase tools, etc., computer supplies that we needed to, even motor vehicles. So this would basically include perhaps the local bakery, medical centres, dental surgeries, even the local carpenter or tradie spending their money on a brand new trailer or some equipment. So basically, many businesses are continuing. Like I said, this has now been extended. It was due to finish on the 30th of June 2022, but in the March budget that we just recently had, it's been extended for another 12 months. Great, we can claim depreciation now, less taxable income, less, well, equals obviously less taxes to be paid. Be very careful though, because if we're bringing forward depreciation claims, basically it means you won't have depreciation to claim in the future years. And that will affect taxable incomes. It could possibly, right at the moment, you know, does your taxable income need to be higher for financing requirements? And then you've got GST implications that could arise as well. So again, it's probably something that you should clarify with us, have a quick chat, and we're more than happy to explain to you about the pros and cons. All right, so that's how we can bring forward and perhaps take advantage of some tax deductions and some government incentives out there. Superannuation. So this is becomes very, very important, and it's certainly a strategy that many utilise and many build themselves up for the future in their older age and their retirement. So let's have a look at some of the different options out there. The simple one is SGC, or Super Guaranteed Contributions. There is a cap which has increased from 25,000 up to 27.5. We've got personal tax deductible super contributions, or what's referred to as concessional. We've also got the ability to tip into super non-concessional or member contributions. You can split contributions and balances between spouses. And you can also look at consolidating super balances between spouses. Now, Section D and Section E are very, very technical and complex areas. And that's something that we should look at on a case-by-case basis if that's what you're interested in. We'll need to probably sit down with you to understand a lot more and go through it in a lot more depth. Certainly proper financial planning will need to be done with any superannuation, let alone those types of arrangements as well. All right, let's have a look at a couple of the more topical ones and the more easier ones to implement. So for the 2022 financial year, so that's the one we're currently in and we end in a couple of weeks, the cap is $27,500 for all individuals, regardless of your age. There used to be different levels for different age groups. At this stage, 2023, there are no changes to the contribution caps at this point. Let's see what happens in the coming 12 months though. All right. So what is a concessional contribution? It's basically the employer contributions, including those that are made under the salary sacrificing arrangements. For all of you out there that are working, your boss at the moment is required to put 10% superannuation away on your behalf and send it directly to your super fund. So that's what we refer to as employer contributions. Some of you out there, like we used that example earlier with Terry Danaher, also decide to contribute or salary sacrifice a little more, and that basically would form part of that arrangement as well. Then we've got personal contributions. So this was something that was introduced a couple of years ago, where, for example, if you're on a $100,000, let's call it, obviously your employer has put in 10% or $10,000 extra to your fund. You also have the ability to tip in some personal or after-tax contributions and claim a tax deduction for that. And obviously, in that case, you'd have the difference of about $17,500 that you could do that. So basically, super obviously gets taxed at 15% versus how much tax are you paying on the outside? Or what is your tax bracket, if you like? Is it 20%? Is it 30%? Is it the highest rate at 45%? Now, be very careful with this. If you have more than one super fund, all contributions made or concessional contributions to all of your funds are added together and counted towards your cap. So don't think that if you've got 3 funds, you can tip in multiple caps. No, the ATO will capture that data and you'll get some nice, sexy tax bills in the mail thereafter. Personal tax deductible, which we quickly mentioned there. So like I said, a few years ago, this changed where you can make personal deductible contributions to your super fund. And basically they allow you to reduce your taxable income. So you can claim these super contributions as a tax deduction on your individual tax return, as long as you meet certain criteria that basically we need to tick, if you like. So very important in that case. Let's have a look at a quick example. We have Charlie. He's self-employed and earns approximately $50,000. Charlie decides to contribute $5,000 to his super fund. He lodges a notice of intent to deduct, and his super fund acknowledges the receipt of that notice as well. So wherever you make personal tax contributions to super and you wish to claim them as a tax deduction, be sure to complete a notice of intent to deduct. So this is a form, it's available on the web, and you will need to lodge to your super fund. They will then talk to the ATO and advise them that's what you're doing. Otherwise, the ATO could turn around and not allow that claim as a tax deduction. So he can claim a personal tax deduction in this case because he's ticked the right boxes of $5,000. His taxable income now will drop from 50 to 45. So Charlie will obviously now only pay taxes on 45 rather than 50. So it's a simple little strategy. You're putting money away for your retirement and a lot of people can utilise. We are also personally allowed to tip in non-concessional, or what I call member contributions into your superannuation fund. So basically non-concessional are from your after-tax dollars and they are not taxed in your fund. You do not claim a tax deduction, so they don't get taxed on the other end. From the 1st of July 17 up until June 21, the cap was $100,000 per person per year. From July 21, the contribution cap increased to $110,000. So be very, very careful again. If you contribute more than your various cap allows you, you'll have to pay possibly extra taxes. There is also a carry forward rule. So for example, you may come in with an inheritance, you might receive a major bonus, or you would just like to get more into your super. This $110,000 per year, we can bring forward the next 2 years and make a contribution of $330 in total. Why would you do that? Because you're getting money into a less taxed or possibly even a tax-free environment. Again, before you go ahead and do something like that, I'd suggest you talk to us because there's again certain rules, and once it's in there, it's very difficult to get out if at all possible. So talk to us. We can certainly give you some advice in that regard. Carry forward rule. So this was a new rule, again, introduced a couple of years ago, and it applies from 2020 financial year. And it basically involves accessing unused concessional cap amounts from previous years if you are under the appropriate levels. So basically, the conditions are you must have a super balance of less than $500,000 to access this rule. You have access to take availability up to a 5-year period. And a reminder that this cap is $27,500. So let's have a look at a little bit of a working example of how our clients are taking advantage of this. So we basically have this particular client here, and in the 18-19 financial year, they contributed, or concessional contributions were $20,000. The cap at that point was 25, so they basically had an unused balance of $5,000. 2020, the 20 year, if you are 15, again, the cap was 25. Now you have a carried forward balance available of 15. And as you can see on and on, it can grow to quite big amounts to take advantage of. So how might someone take advantage of such a rule, if you like? So we basically have Sally, and during the 19 year, there was about $5,000 contributed by her employer into her super fund. Her balance of her fund at that point was $480,000, and it was growing though. And as a result, she's got an unused carry forward cap of $20,000. Now, during that year, she didn't contribute any more because she simply didn't have the cash flow or the spare cash to allow her to do it. The following year, $3,000 was contributed by her boss. Again, her balance was below 500 still. So now we have 20 plus the 22 cap, which basically means that she's got $42,000 as an unused cap. The following year, nothing was contributed because she took a bit of time off work. So 42 plus the new 25, basically she has a balance now of 67 as an unused cap. Then the following year hit, so this current year that we're in, she went back to work, her super fund balance dropped because perhaps the share market or property values dropped, so she was below the 500. So her boss tipped in $10,000 during that year, and she decided also to sacrifice 20. So basically, and some personal contributions as well. Now that's over the cap, basically, that she's normally allowed to do. But she's basically decided to take advantage of her carried forward cap and tip more into super. We can access this information from the ATO, providing your records and your super funds are up to date. And you can also talk to your super fund, respectively, to see what your carry forward caps are. So it's a great strategy that many are now taking advantage of. And it simply means that if you don't have the extra money to tip into super this year, but maybe perhaps you do next year or the year after, you can catch up on those balances. So it's a very positive thing that was introduced 3 or 4 years ago by the government at the time. Quickly, for those of you business owners out there or employers, superannuation or SGC is rising. It has started and it will continue to do so. So for this 21-22 financial year that we're currently in, you must be paying superannuation or SGC of 10% on the wages of your employees. And that needs to get forwarded at a minimum on a quarterly basis. You can do it more frequently if you like. Now, from a couple of weeks down the track, so 1st of July 2022, it's rising to 10.5%. And you can see over the coming years, it will continue to rise by 0.5% each year. And on the 1st of July 2025, it'll be up to 12%. So for those of you employers out there, you should be looking at that because that'll come straight off, obviously, your bottom line, but extra obligations that you will encounter. On top of that, it will also possibly affect things like your work cover premiums, increase them slightly, and it will also affect for those of you that are registered for payroll tax purposes as well. Okay, so contribution caps, like I basically said, or what does that mean for you employers? As you can see, you know, 100,000, if your wages are $1 million, at the moment you're paying 10%, which is $100,000. In the years to come, you can see how it'll increase out of your basically pocket. And like I said, be very careful or understand the effect that it'll have on your work cover and possible payroll taxes as well. Another thing that the government did basically is the rules will be changing. So in the past, if an employee did not earn more than $450 per month, then you did not have to pay them superannuation guarantee charge. So from the 1st of July 2022, so again in a couple of weeks, it doesn't matter how much an employee earns, so $1 upwards, so basically you will need to pay superannuation on their behalf. Who's that going to affect? It'll affect cafes, restaurants, perhaps, you know, where that person or those employees only did a shift a week and they weren't earning more than $450 per month. Now, everyone will basically have to, you'll have to be paying for super for everyone, regardless of their earnings. Now, what should happen with both the SGC and even these type of arrangements is those of you, or pretty much everyone now, should be lodging records through simple touch payroll. That might be done through Xero, for example, that I know many of our clients utilise. That should automatically happen in your software come July 1. If you're not sure or you want to double check, again, speak to us and we'll certainly just clarify it all for you. Okay, so superannuation, it keeps going on. It's the gift that never ends. Many of you are out there, and especially those above 60, are possibly pulling down pensions from your superannuation fund. So you can only do this if you're in pension mode and you've done the appropriate financial planning and legal work to do so. There's been a halving or a 50% reduction in the amount that you've pulled out in the last couple of years. The government introduced that because of the COVID crisis. And again, that extension or that relief has been extended to the upcoming financial year. So what does that mean? It means, for example, if you're aged under 65, the rate is normally 4%. That's been brought forward to 2%. So you only have to take 2% of your balance, if you like. And you can see as you get a little bit older, the minimum pension requirement increases. But again, we've got grace for another 12 months. And the government have said because investments, for example, may not be performing or dividends weren't at the levels that were paid by various companies, that's why they've done that pension adjustment, if you like. Tax cuts. So the magic word that we all want to hear, especially with the cost of living at the moment. So basically the great news is before the Liberal government got the boot a few weeks back, over the last couple of years, they've been introducing some tax cuts for the current 2022 year, which you'll all be lodging tax returns shortly. And then for the next year as well, these are the legislated tax rates. So it's quite simply, you know, they haven't changed much, although the government has extended some of these bigger thresholds. Now, from 2025, it is legislated already. So if we just, we can clearly see that they're getting rid of these middle tax brackets, basically. So the first two will not change, but then basically these next three will be removed. So moving forward, anyone that earns between $45,000 to $200,000, you will have a flat rate of 30% basically. And that's in comparison to 32, 37, and even 45. So you can see they basically are trying to clean up the tax brackets. So, and get rid of bracket creep, as they call it. Like I said, in the election, the Labor government, Mr. Albanese, has come out to support that he would support these tax cuts. I suppose all we can do is time will tell in that regard. The one thing that I will mention is that we've heard that there will be a special budget come September, October. So let's, time will tell with why we're having that and what changes they will make. Medicare levy thresholds, just quickly, because I'm wary of time, they're not changing too much. Every year they go up a fraction, as you can see, before we all have to start paying Medicare levies. So I'm sure that will continue. Like I said, we have a budget, a once-off coming up. Labor Party has announced it to happen in about October. The budgets are normally held in May each year federally. It was brought forward this year because of the election and we had it at the end of March. But basically we'll see what that means. We'll see what happens. So stay tuned for more information. And we'll certainly, when it all happens, like I've always done, we'll continue to keep you updated through newsletters and brochures where we think you need to basically know. Just quickly, COVID being the topical thing that we've all gone through recently or over the last couple of years. As per our newsletter that we sent to our database back at the beginning of March, basically the last budget confirmed that the costs of taking COVID tests to attend your workplace will be tax deductible in this year. So if that's something that you've done, certainly let us know when we start compiling your tax returns. And we'll certainly have all the checklists and all that type of stuff up on our website ready to go very shortly. Property investors out there. So I just wanted to quickly mention there's not been too many changes out there. Please ensure though that your tax records are up to date. Your receipts are on file because we certainly, like I alluded to earlier, the government is again targeting properties and property landlords out there. There's certainly things like the difference between repairs and maintenance versus capital or structural, you know, those type of things. So there's a couple of brochures on our website that you can access. You know, what are the tax deductions available, and it certainly goes into some more detail and gives working examples around things like interest and repairs and depreciation and those big ones as well. So feel free to download those off our resources area on our website, and I'll show you how to access all that shortly as well. Banks. So how do we keep these banks honest? Interest rates are climbing. I'm sure you've heard all that all over the news and social media, etc. And like I said earlier, the experts are tipping they will continue to climb. So many of our clients, the phones have been running hot over the last month or so. They're trying to, is it a possibility of locking in cheaper rates? Is it a possibility of putting cash buffers in place now, ready for what could happen? You know, investment loans at the moment, if you're lucky, you should still be starting with a 2. Although I noticed yesterday the big 4 banks passed on straight away the 0.5% increase. You should be running a regular or an annual review of your loans. So, you know, sometimes I'm amazed that, you know, yes, people get 25 or 30-year loans and it's like a set and forget approach. Contact Lucy. So Lucy is inside of our office. She works solely with our clients here at Financially Sorted. She can go shopping on your behalf or even understand what your goals and objectives are and see if we can assist in any way. Sometimes it's just a matter of a phone call to a bank, or sometimes it's a matter of who you know rather than what you know. So please feel to reach out, ask questions, let us know, and we'll certainly go a long way towards helping. But you must be looking at your loans and ensure that they're still competitive. And things will continue to change as we head into the rest of this calendar year. Financial planning, insurances, superannuation balances. So the last 2 years have had some major impacts on our superannuation balances, and it will continue to do so. Look at the market, for example, how volatile it is. That's because of COVID. We've obviously had some major floods and all that here in Australia as well. So it's driving up costs of living. We've got petrol, and we've got basically the Ukraine situation and Russia going on. So how has that impacted your super? Is it still in the best arrangement? Do you need to look at some insurances or change your insurance? So again, contact Daz in our office. He'll certainly be able to assist you with all those queries. And it's something that you should now be certainly paying attention of. You should have been doing that a while ago, but now is the right time to do it as well. So like I said to you earlier, we have our webinar areas, and you can access this along with the slides and the webinar and even our past webinars on our website. There is the address there. It's simply financiallysorted.com.au, and there isn't a webinar icon, which you can click on, and we've got webinars up on there. So this one will be added in about 24 to 48 hours along with the slides. There's previous webinars that cover small businesses, that cover property and other topical situations at the time. So feel free to download it, watch it again, etc. And if you've got any questions, we're more than happy to assist in that area. Basically, what we've also done on our website is we've got some tax planning guides. So one for individuals and one for businesses. So again, feel free to access those guides. You know, they're 20 and odd pages long, each of them, and they go into a lot of what we've just chatted about. And also we'll go somewhat further with some other areas. So they've all been there, popped on there for you guys to download and assist. And again, if you've got questions, please just reach out to us. And one extra thing that we've added to our website just recently is occupation guides. So we're again on our website under resources. We've got over 30 occupation guides for you guys to download. So this is about a 4 to 6 page document on each of your occupations, from teachers to nurses to factory workers, hospitality, building and construction. There's police. There's, like I said, over 30 odd occupations out there. And what I've tried to do is make it very simple for you and tell you what's tax deductible or what are the common tax deductions for your particular field or your occupation. So feel free, jump on there, download the occupation guide that's applicable to you. Again, ask us any questions if you've got those. So more than happy to help. Now, before I just quickly wrap up, there is a couple of questions here. So I'm just going to click on that. I'll just see if I can answer them quickly. So does SGC apply to casual employees from $1 up? And the short answer to that is yes, from July 1. So like I alluded to earlier, this is a government, basically, they've changed the law that'll be taking effect from the 1st of July. Any dollar of earnings, SGC will apply. So thank you for that. Does compulsory super contribution payments for employees apply to those under 18? The short answer to that is yes. In the past, if they haven't, for example, if they've done one shift a week, then basically that's not applicable. But from July 1, it's going to pretty much kick in as well. All right, and finally, I'm confused with the 50% pension drawdown. Do I need to draw down full or 50% after this month going into 2023? So basically, for those of you in pension mode, through your self-managed super fund or even through another either industry or regulated fund, you must take a minimum pension drawdown each financial year from your super. And your super should be providing you with that minimum amount. So for those of you that are our clients with self-managed super fund, certainly Cassie and Andrea can help you with that number. And it's based upon your account balance. Now, basically, in terms of as long as you take the minimum, it's the minimum that has been dropped. And you don't have, you can still take more if your cash flow allows, but the government have given you some relief. And yes, you have done it for a couple of years in a row, but you need to make sure that that continues in the future, and it's been extended for next year. So no problems at all. If you need any further clarification, like I said, reach out to ourselves. Certainly Cassie or Andrea will be definitely able to help in that area with your superannuation. So just quickly in finalising, because I'm wary of time, and I thank you all for taking an hour out of your day. What should I be doing next? Or what are the 3 questions? So again, what should you be doing today leading into the 30th of June? Can you take advantage of some of those opportunities or tax or super strategies that we had a chat about? So no problems at all. What should happen on the 30th of June? So should they be doing anything, up until the 30th of June? And certainly as it gets closer, we spoke about making sure your super contributions are paid before June 30 rather than afterwards. But then more importantly, what should be happening after the financial year or from the 1st of July? And I think it's a great thing that you guys as business owners and superannuation investors or owners, you should understand what your numbers are. And indirectly, you should not be waiting till May or June to analyse those numbers and do tax planning strategies. You should be installing techniques more frequently. You should understand what your margins are. So from July 1, you should be certainly doing that more frequently to ensure that you're ahead of the pack. Okay, so on behalf of myself and the team, I'm very thankful for you all jumping in today. Like I said, give us 24, 48 hours and all this will be uploaded to our website. Please, please, please talk to us for any assistance or any guidance that you need. We're only a phone call or an email away and we're more than happy to help. Make sure that all your compliance is up to date. It's been a horrendous couple of years as an accountant and we're still madly catching up with a lot of stuff because of JobKeepers and grants and cash flow boost that we helped many of you with. But right, what do you need to do to be up to speed? And it's certainly now is the time to get financially sorted, and feel free, here's our contact details. So on behalf of myself and the team, thank you very much for joining, and we're here to help, and we appreciate your ongoing support. Cheers. Thank you.